Why U.S. cities are going broke. In recent years, it has become increasingly apparent that numerous main cities in the United States are experiencing severe financial difficulties. These cities are essentially bankrupt, which is reason enough to necessitate widespread concern and scrutiny. A concerning trend is emphasized by the decrease in sales tax revenue, business tax revenue, and hotel stays. Recent studies have shown that 53 of the country's major cities are unable to make enough money to cover their expenses. The critical issue of considerable capital needs across the nation's urban centers is underscored by this financial shortfall. Several cities have accumulated debt over the years to finance essential services, a strategy that is currently at a juncture. This is the background to this predicament. Public officials are currently tackling the Herculean task of reducing spending to address the growing fiscal challenges. The fundamental issue is the precarious equilibrium between the preservation of city services and the management of debt. Deteriorating infrastructure, diminished public services, and a series of difficult decisions that city officials must make to guarantee financial stability are all potential consequences of excessive debt. The cities that are experiencing financial difficulties are currently confronted with cash flow constraints that could potentially be resolved through revenue growth. Nevertheless, the unavoidable consequence could be a decrease in services or benefits in the absence of viable options for increasing taxes or alternative revenue sources. Therefore, why are so many cities in the United States on the verge of financial collapse? What implications does this have for the residents of our most populous and active metropolitan areas? The operation of a significant metropolis is inherently costly. Let's look at New York City as an example, which has a population of more than 8 million and spans 5 counties. A substantial financial investment is required due to the city's extensive and diverse requirements. The maintenance of public services and infrastructure in a densely populated, vast area necessitates substantial resources. The city can finance essential services, including the construction of schools, the enhancement of water and wastewater infrastructure, and the support of affordable housing initiatives through the mechanism behind these bonds. However, this method is not without its hazards. An increasing number of experts argue that municipal and state governments are overextending themselves by issuing bonds for expenditures that they may not be able to afford. In an evaluation by Truth in Accounting, New York City received a shockingly low grade. The city's debt, which amounts to $177 billion, is disclosed by Sheila Weinberg, the founder and CEO of the nonprofit organization. This translates to $61,800 per taxpayer. Conversely, the current debt figure of approximately $96 billion is less according to New York City's calculations. At present, the city's debt ceiling permits borrowing of up to $125 billion, suggesting that there is a remaining capacity of $25 to $30 billion. The pension funds of New York City are relatively stable with an 80% funding level and a goal of achieving full funding within the next decade. Nevertheless, there are substantial dangers associated with stock market fluctuations. For instance, Detroit's bankruptcy in 2013 was partially the result of unsustainable retiree payment obligations. Detroit revised its pension program to limit disbursements to former employees in the aftermath, thereby allowing the city to increase its reserves. Despite these obstacles, the accounting regulations do not mandate that this debt be incorporated into the balanced budget requirement. The non-payment of an invoice does not inherently affect the balanced budget. In the fiscal year 2022, cities such as Chicago, Philadelphia, Houston, Portland, and Miami owed more money than they possessed in assets, as emphasized by Truth in Accounting. Before a subsequent recovery, the stock market declines that year, which were the most severe since the Great Recession, further exacerbated the financial difficulties. Leadership. Cities across the nation have been compelled to institute rigorous budgetary controls as a consequence of these financial constraints. In 2024, Mayor Eric Adams of New York had to deal with a $7 billion budget deficit that was primarily due to the influx of immigrants and asylum seekers. Adams implemented a succession of spending reductions as part of the PHU program to eliminate the GAP initiative to rectify this deficit. This strategy, in conjunction with an unexpectedly resilient economy, contributed to the stabilization of the fiscal outlook for fiscal year 2025. Nevertheless, the city continues to be in a precarious position. A series of 3.5% cuts, which amounted to nearly 15% in total reductions, was incorporated into the mayor's plan. These cuts have had a significant impact on New Yorkers' livelihoods. For instance, the City University of New York has abolished specific courses and increased class sizes as a consequence of funding reductions for public education. Libraries have also been impacted as numerous institutions have reduced their operating hours. A significant challenge for residents who depend on weekend access for themselves and their families is that no neighborhood library is open 7 days a week. In addition, the mayor's budget cuts had an impact on programs that were intended to provide alternatives to incarceration, a strategy that had previously alleviated the strain on the city's facilities. Cities such as Portland, Oregon, Washington, D.C., and Los Angeles are also adopting fiscal austerity measures. These municipalities are currently facing a budgetary gap that necessitates immediate attention, as they are grappling with a combination of declining revenue and increasing compensation. The government's capacity to fulfill existing obligations and fund new programs will be significantly limited in Los Angeles County as a result of stagnant revenue growth in 2024 and beyond. Conversely, Portland is confronted with an imminent fiscal precipice as it lacks the necessary resources to resolve its ongoing financial difficulties. The city's demand for resources continues to exceed its availability. Credit ratings. Municipal bonds are a popular option for cities seeking to raise capital in the bond market. For example, Portland's AAA credit rating renders it an appealing alternative for investors. The interest on municipal bonds is exempt from federal taxes, which results in reduced borrowing costs for state and local governments. Fitch's scale for investment-grade ratings ranges from AAA to BBB, while junk or speculative grade ratings range from BB to D. Credit rating agencies assess the capacity of cities to fulfill their debt obligations. Cities such as Chicago have been classified as speculative grade for an extended period. However, they have recently experienced rating upgrades as a result of proactive pension payments. This budget is balanced without the need to raise the city's base property tax. I was elected to end the government's addiction to regressive taxation that has driven working families to the verge, and that begins today. This sentiment is indicative of a more general issue. The public frequently implies that cities are effectively managing their finances when in fact elected officials may employ budgeting strategies to avoid raising taxes while still offering a wide range of services and benefits. Additionally, factors like climate change are exacerbating the cost of public administration. We have initiated the process of contemplating the city's climate risk in our bond underwriting and are striving to be open and transparent about it. In the face of climate change, we must allocate resources to the development of coastal resilience to mitigate the effects of cyclones and storms. Assistance from the federal government. Cities occasionally depend on federal assistance to maintain their financial stability during periods of crisis. I think during the pandemic there was, of course, very real anxiety about whether the model that is New York City would continue to work. During the pandemic, New York City received an estimated $28.6 billion in federal grants from a variety of programs. The city was able to reallocate other resources for additional expenditure, effectively providing a financial lifeline, even though these funds were ostensibly for COVID-19 relief. An uncommon occurrence in the past 4 decades, tax revenues in New York City are anticipated to decrease for the fiscal year 2024. There's real urgency, and I think people are not appreciating that. The city may investigate alternative revenue streams, including property taxes. Projections indicate that New York City may attain its debt ceiling by 2029, which is approximately 4 to 5 years from now, to satisfy its ongoing capital requirements. The city has the potential to address issues such as overcrowding, infrastructure deficiencies, and hazardous school conditions by issuing debt to fund a portion of its capital plan. However, there are risks associated with the inability to issue debt. The balanced budget requirements for state and local governments are intended to prevent unsustainable debt. However, they may induce a false sense of security. Year after year, elected officials frequently assert that they have balanced budgets, even though they employ accounting and budgeting gimmicks to conceal financial instability. Thanks for watching. If you enjoyed the video, don't forget to like, comment, and subscribe. See you in the next one.